Welcome to The Explainer. Today, we're taking a look at Euronext, but from a very specific angle, that of a public market investor. We're going to peel back the layers on what is essentially the financial plumbing for pretty much all of Europe. Let's jump in.
So let's kick things off with a question to get our heads in the right space. What if you could own the actual toll roads of European finance? I mean, think about it. Euronext isn't some high-flying trading firm making risky bets. Nope. They're more like the owner of the essential highways, the infrastructure that all the money has to travel on. Every single time a share that's bought or sold, or a company decides to go public, even when someone just pulls up market data, Euronext is there, collecting a small, steady fee. It's a toll booth business, really.
And when I say these are the busiest highways in Europe, I am not kidding. Just look at the numbers for 2024. Euronext processed, get this, 2.7 trillion euros in cash equity trades. Now, to really understand what that means, that's more than its two biggest competitors, the London Stock Exchange and Germany's Deutsche Börse, combined. This isn't just being number one, this is straight-up dominance.
So the big question is, how on earth did they build this thing? And more importantly for us as investors, is this fortress actually built to last? Okay, so their biggest competitive advantage, their moat, really comes down to this one powerful idea: liquidity gravity. It sounds fancy, but it's actually super simple. Think of it like this: money attracts more money. The more people are trading on an exchange, the deeper the pool of buyers and sellers gets. And the deeper that pool is, the more other people want to jump in because they know they can get their trades done easily. It becomes this massive, self-reinforcing cycle that is just incredibly tough for any competitor to stop. But here's what's really smart, and what should catch an investor's eye. This fortress isn't just built on the shifting sands of trading volume. Management has been very deliberately de-risking the business. They've shifted the model so that today, a whopping 58% of their revenue, that's the majority, comes from stable, predictable, recurring sources. We're talking about things like listing fees, selling market data, post-trade services, stuff they get paid for no matter how crazy the markets are. Now let this sink in. Just that stable, recurring revenue, that predictable income, was enough to cover 153% of all their underlying operating costs. What does that mean? It means Euronext is already profitable before a single trade even happens. All that trading revenue we talked about, that's basically just pure icing on an already profitable cake. It's an incredible position of financial strength. All right, so the business model looks rock solid, but talk is cheap, right? Let's dive into the engine room, look at the actual numbers, and see how this all played out over the last 5 years. So the last 5 years have been, well, completely transformational for Euronext. And it all boils down to one massive move: the acquisition of Borsa Italiana, the Italian stock exchange. Now, these big mergers can be messy, right? But by 2024, they'd not only finished the integration, but the cost savings they got from it, the so-called synergies, were blowing past the original targets. That, right there, is a sign of a management team that knows how to get things done.
And you can see the results right here. The numbers really do speak for themselves. Revenue grew at a solid 19% a year. That's fantastic. But here's the really important part for an investor. Their profit, measured by something called adjusted EBITDA, grew even faster, over 20% a year. When profits grow faster than sales, that's what we call operating leverage, and it is a beautiful thing to see.
So the key takeaway here isn't just growth, it's profitable growth. I mean, an adjusted EBITDA margin hitting almost 62%, that is absolutely world-class. It means for every new euro of revenue that comes in the door, a huge chunk of it, like 62 cents, is dropping straight to the bottom line. That is the kind of efficiency and profitability that investors dream about. And what did they do with all that cash they were generating? Well, they didn't just sit on it. They used it to make the company even stronger. See, after buying Borsa Italiana, their debt level, their leverage, went up to about 3.2 times their profit. But then they put that cash flow to work. And in just 3 years, they paid that debt way down to a super conservative 1.4 times. They basically rebuilt the fortress walls, making the balance sheet rock solid again. Okay, so the big acquisition is in the rearview mirror, the balance sheet looks great, so what's next? Where's the future growth going to come from? And maybe more importantly, how do we as shareholders get paid? Well, they've laid out a pretty clear strategy for the next few years, called Innovate for Growth 2027. And it's basically a 3-part plan. First, keep growing those really stable non-volume businesses, the data and services. Second, start pushing into new territory, like fixed income and commodities.
And third, you got to protect the crown jewels, right? So they're going to keep building on their leadership in their core trading markets. Now, for any of you who are income-focused investors, you're going to love this. Their shareholder return policy is just beautifully simple. No complicated formulas or buyback schemes. It's just, we're going to take 50% of our reported net income and we're going to give it back to you, the shareholders, as a dividend every single year. It's clear, it's consistent, you know exactly what to expect.
And to put a real number on that, for the 2024 fiscal year, that simple policy means a proposed dividend of €2.90 for every share you own. That's real cash in your pocket on top of any gains you might make from the stock price itself.
So, look, it's a pretty compelling story so far, right? We've got market dominance, huge profit margins, smart management, but all of that leads us to the single most important question for any investor. Is it a good deal? What about the valuation?
So let's break down the two sides of the coin here, the bull case versus the bear case. On the bull side, it's pretty clear. You're buying a market leader, a fortress built on recurring revenue with amazing profit margins and a great management team. Simple. The bear case? Well, it's about the risks you can't ignore. Trading volumes go up and down, that's just a fact. Competition is fierce, and when you're this important, you're a big target for regulators and, of course, cybersecurity threats.
So where does the stock price sit today? If you look at how it's valued compared to its main European rivals, it's kind of in the middle. It's trading a little cheaper than the London Stock Exchange on a price-to-earnings basis, and on another metric that looks at the whole company value, including debt, it's pretty much right in line with Deutsche Börse. So what does that tell us? It suggests the market isn't giving it away for free, but it's also not charging a huge premium for what is clearly a high-quality business.
And so that really brings us to the final question, the one you as an investor have to answer for yourself. After all this incredible transformation, is Euronext a top-tier, fortress-like business that's just sitting there at a fair price? Or is the market's caution justified? Is it telling us that the easy part is over and the next phase of growth is going to be a much tougher fight? That, right there, is the multi-billion euro question. Thanks for tuning in.